We're pleased to welcome now Jim Leggette, lecturer of economics at Mississippi State University. Hey, Jim.
Morning. Long time no talk. Well, not that long. Couple months, I think.
Yes, sir. Well, I think the word to describe the current conditions in the markets for sure, which to some extent are a reflection, at least of investor view of the economy, is a volatile. I mean, it's just all over the map, isn't it? We get, I was talking about this earlier, we get a jobs report, jobs created report, as is the case last Friday for the month of July. It comes in far below expectations. And then today we get first-time unemployment claims, which came in a little below expectations. So somewhat of contrasting data. The market sells off Friday and Monday big time because of the new jobs. And then today markets are recovering quite nicely. Big rally on Wall Street underway right now because we get unemployment data that was a little more tepid than expected. How do you explain all this?
Well, I think probably out there's a kind of, I'll call it a methodological question is, one report doesn't prove anything. And I think people probably overreacted to Friday and the unemployment number. But I think the bigger question, I'll call it, there's just a general angst out there about a variety of things. And as we know, elections don't do anything to reduce angst. In fact, I think they create it, and I think both sides profit from angst. But I was just playing around with it. If you didn't know about all that stuff, if I told you were an alien, I told you the unemployment rate was 4.8%, prices were 2.8%, and GDP grew by 2.8%, and we're about the all-time high of the stock market, you go, I like this, but we don't, And I think probably we're still feeling stung from inflation. And I think probably another thing is whoever happened to get the post-COVID economy was going to be in for a rough ride. So, and I think you and I have chatted about this kind of before, is I think we give presidents too much credit when things go right, and we blame them too much when things go wrong. So, but that doesn't mean we don't kick them out if we don't get what we want or we think we want.
I absolutely agree with that. And I think the thing that could impact the economy, markets included, as much, if not more, than policy coming from a White House is just the attitude and the rhetoric and the overall philosophy and position about the private sector in general. And because, businesses, when they're thinking about taking risk, making big-time capital investments, it's all about what I call faith, confidence, and certainty. That's what drives it. And if they're unsure, they don't really feel like they have clarity, or more importantly, let's say you're in the energy industry today and you got a White House that wants to put you out of business, which is what we have, you're probably not likely to make a lot of investments in growing your business.
And if you do spend billions of dollars, your board will probably ask you to pursue other opportunities. And I think maybe what markets need is this yo-yo back and forth this way and this way. It drives everybody nuts. And I think, the founders were onto something. This divided government stuff is a pretty good idea. And what seems to be the best economically, if the party that controls the legislative branch is not the same one that controls the executive branch.
Yeah.
Because both parties overreach. You can certainly say the Democrats overreached in 2021. But if you hadn't lost the Senate, you might not have had all the junk in that Inflation Reduction Act, which Orwell would be proud of that title because it was anything but.
Well, when you think about faith, confidence, and certainty, which I totally believe are the drivers of business expansion, investment, hiring, risk-taking, et cetera, when you got divided government, you can have faith, confidence, and certainty that very little to none will happen. And that's actually, it's not a bad thing. Exactly.
We all probably, folks who've been in the private sector have a bias for action. I certainly get all that. But sometimes action is not good.
Yeah, exactly right. So You know, a lot of folks, of course, say that all the polls reflect this, that economic issues, in particular crushing inflation, which is taking its toll on American household finance, rank as their top priority when they think about casting their ballot for a presidential candidate. My concern is, Jim, that a lot of people think, okay, if we get Mr. Trump back into office, we're likely to see prices of the goods and services that I customarily acquire return to the 2019 levels. You certainly could see. It's not. I just don't see that happening, and I think it would be wise and prudent on our part to really be realistic about this. We could certainly see inflation leveling out. That's still inflation. It's still increasing, but it's not at the rate that it once was and at the frequency of just price increases. But I don't see stuff going back to 2019 levels. If it does, we've likely encountered a reckoning, a recession.
An ugly one. I think, when you think about inflation, what you're really thinking about is price stability. You don't want it going up. And if something's $100, it stays $100. And your point about losing 20% price, 20, 25%, get back to 2019, be careful what you ask for, because that's the Great Depression. Prices were down by a third. And the real answer is well, no one had any money, so therefore you were, And in fact, the textbook I use, they actually address this. It has something to the fact is inflation's not good, but deflation, which what you were talking about, is worse.
Yeah.
And two episodes in our economic history, certainly the Great Depression, the late 1800s. We flirted with that after the financial meltdown in 2008, 2009, because people didn't even know what deflation meant. All of a sudden, we're writing for the Wall Street Journal about it. So they probably had to go back to the archives and figure out what the heck it was. Heck, I did too, because that's not the kind of thing I ever worried about.
Yeah. So Jamie Dimon, of course, he runs J.P. Morgan Chase, and he doesn't hesitate to weigh in. I mean, he runs a big bank, and he should on kind of where he sees things going from an economic perspective. In the last 24 hours, he says, I don't think we'll see the Fed's target of 2% inflation. That's been kind of their standard benchmark as far as their mission of price stability for a long time. He says, I don't think that's coming back. He says that deficit spending and, quote, remilitarization of the world will stand in the way. That's an interesting aspect from Mr. Dimon. And then, of course, the bank itself that he runs has now increased the odds of a recession to 35%. I don't know how in the heck they come up with a random 35% number, but just two bits of economic forecasting from the big bank.
And he certainly has his insight. The first one, their models produce 35%. I know how to get there, and it's part math and it's part judgment. But the one I found more interesting, what you're talking about, the get to 2%. He basically said, "Hey, we spent a bunch of money that we don't have, and one day it's going to catch up with us." And I didn't think about, we don't really know what's going to happen with the Ukraine. But defense spending across the world is up, and while it's perhaps necessary, it's not a productive spending use of our money.
Yeah, I totally agree. So
as militaries are, they're kind of in the business of destroying things.
Yeah.
Or keeping people on. But it's not the most productive use of your. If we could, wouldn't we rather have 5% of our 4 to 5% of our GDP going to fund pharmaceuticals? But you got to have some military, or otherwise you better be in Switzerland and have everybody else's money.
That's right. But you've got nations that are certainly not as economically affluent as ours is, who are having to spend a bunch of money just to stay alive on the planet. I mean, if we could just eliminate those threats, and I know that's maybe idealistic on my part, but, man, the whole world would benefit. That's why I'm kind of, I guess, maybe privately pulling for Israel to bring some stability to that area so we can just kind of check that box and not have to constantly be worrying about these terrorists. We got a break right here, but if you could hang around, we'll continue this discussion on the other side. We got Jim Leggette, Lecturer of Economics. Yep, absolutely. Sounds good. We're stepping aside for a break in the Element Wealth studio. Coming right. We've got Jim Leggette, Lecturer of Economics, Mississippi State University. So we were just talking about some of these prognostications from the big banks who have armies of economists and so forth that track this sort of stuff, and it's used to guide them in their decision making and running a big outfit like that. I mean, it's anybody's guess at this point, right? You felt like after the jobs report Friday, everybody was saying, "Oh, it's a done deal. We're headed for a recession." And, of course, the VIX skyrocketed as well, just indicating the volatility index for investors. Today, we get a little bit better jobs report on the unemployment claims front. Markets recovering somewhat. What do you think they're thinking about the different scenarios from an economics perspective? A Harris presidency versus a Trump presidency. I think that's factoring in big time.
Or it has to. I think they don't know which one. And if you look at the economic, I used to think Republicans were good for the economy. Now I kind of have mixed feelings. I think they like some parts of the Trump agenda. I think the trade policy makes them nervous. We know what the Democrat policy works. I think what they really want, please give us mixed government. I don't really care. I mean, divided government. I don't really care who the president is. I think the other thing, which the interesting point we kind of stumbled into, there's the political uncertainty in the United States. There's the political uncertainty in the world. You were talking about Israel. That has all the potential in the world to spill over to something nasty. And, of course, you got Iran stirring the pot, and probably the Saudis are sending them money. And we've forgotten about the Ukraine. Mm-hmm. And Russians are looking bogged down as much as they were in Afghanistan, even more so. And then I recently heard a fellow who had given a talk who had been to Poland in the last year or so. And that place is basically a military boomtown because of all that, And if you think about the Polish history, they kind of got tired of being invaded. And don't forget, 80 years ago, it's the anniversary of when the Germans shut down the uprising in Warsaw, one of the more brutal chapters ever. So and then we don't know what China's ambitions are. But I think probably one of the things all this volatility is about, there's all kinds of things that could go wrong in the world right now. Internationally, let's just say hypothetically, if the Trump assassination on Trump had been successful, you could envision all kinds of ways where that spirals out of control.
Yeah.
So while this is not a perfect analogy, World War I was precipitated by an assassination attempt. The Emperor of Austria-Hungary, and now how history hinges on a little time. The fellow who assassinated him had missed his first opportunity, so he was probably going, "I'm failed as an assassin." The limo driver took a wrong turn and ended up in a dead end, and there the guy was. So he had that opportunity. If the guy had Google Maps, we would have had a different world. So I guess what I'm trying to get guests to think about here is we can model the economy all we want to. And we can look at forces at play. But some wild card out there, you probably heard the phrase, a black swan event changes all.
Yep.
The pandemic has still changed the world that we live in. Because 2019, all in all, pretty good year. Pandemic scrambled about everything you could possibly think of, and we're still not done.
Yeah, I think you're absolutely right. It was pivotal. It was watershed, and to some extent, we haven't fully, I guess, recovered, certainly from an economic perspective, and lots of uncertainty. But, in focus, of course, are these presidential elections, and their approach to economic policy couldn't be more different, honestly. I'm not sure we've had this large a gap between the two major parties' stance on economic policies, it's relating those to everyday Americans, I think, is what's going to influence the vote. And we got something looming, Jim, which is the individual provisions of the Tax Cuts and Jobs Act scheduled to expire at the end of next year, of 2025. You know, this is going to be front and center and just a knockdown, drag out. You're right, in the Congress. And it all depends on, the makeup of control, House, Senate, and White House to see where we go.
And the reason it's even sunsetted to begin with, whether you like it or not, the fact something as important as that goes away is because you did it kind of a backdoor way through the process. And I understand why you do it that way, but I think markets won't say, I don't care how bad, well, maybe they do. I'm being silly here. I don't care how bad the rules are. Just let me know what they are, and then I can figure it out. But if you don't know what the rules are, that you sit and wait. And your example about the oil guy said, well, we're going to hold off on this capital project until we see what the rules are for today.
Yeah, and you're right. If they could have gotten 8, I think, Democrats to come on board with them, could have made them permanent. Would have been able to bypass the so-called reconciliation rules that allow passage of major economic tax spending legislation like this with a simple majority, but you have to do it within those constraints which are calculated over a 10-year period, and they opted to make the individual cuts expire while making the corporate rate the cuts permanent. But some of that's being scaled. Some of the corporate the immediate expensing provisions and writing off of R&D and so forth. I mean, we're already seeing that's starting to take its toll on capital investment. I get nervous. I got to tell you, Jim, the one indicator I look at more than any that makes me nervous about the future from an economic perspective is capital investment.
And I agree with that. And it's what your source of angst is. It's very volatile, like silly swings. And then, and probably what drives that angst, if you don't plant your field today, you're not going to have anything to eat tomorrow. And since we don't save very well, we don't have a good investing pool. And if you look at say why the United States became strong, it's because we had all that savings left over from World War II that made a difference. Probably your business thrived because rather than just spend the money, you put money back into it. And,
always,
and that's every business.
Always.
Yeah.
Always.
Don't need your seed corn.
I got to tell you, I was always waiting for a streak of really good months from a bottom line perspective, and I was always thinking about what can I do to plow this back to cultivate for the future. And that's what facilitates growth. There is no way to grow without that, honestly. Certainly in most industries.
Doesn't work well.
Yeah, doesn't work well. Now there's always a temptation. Well, I could just put some of that in my pocket, and reward myself for these good times. But then all of a sudden, when you should have been making investments, you didn't to prepare for the future. But when you see big businesses start to pare back, and honestly, the saving grace has been this artificial intelligence boom. I read a report the other day from one of my industry trade publications that says that in the next 3 years, we're looking at $1.4 trillion investment in just data centers to power AI.
Wow.
$1.4 trillion in the next 4 years. Now, most of that is the big players, Amazon, Microsoft, Meta, and Google. But then you start looking beyond that at a host and a number of smaller as in, they're still multi-billion-dollar companies, but smaller relative to those big four. $1.4 trillion. I don't ever remember any prediction like that on any sort of industry or new innovation.
And then, there's probably a little bit of gold rush in there, but I get that. But more importantly, is if you believe the part, and you have to believe some of it, is it's going to change how we do stuff. Maybe as radical as when we just figured out how to use Google.
That's right.
And
that's a
that
good
seems
point.
primitive. Like I got to go to the library a little bit. That used to be how I had to look up everything. And now the knowledge of mankind is, well, not all of it, but a good chunk of it's at our fingertips.
Yeah.
And imagine the way I look at artificial intelligence right now. It's like Google on steroids, and that's okay.
Yeah. Yeah, I think we'll all benefit from it. I really do. These are pretty smart people that make these decisions. $1.4 trillion is a bunch of money, and I think that's going to lead our economy, honestly. And we're fortunate that we're able to innovate that way in this country. No other country really has that kind of environment. We got to go, but I appreciate you, as always, Jim, for calling in. Enjoyed the conversation, sir.
It was an interesting conversation. We'll see you next time.
You got it. Jim Leggette, lecturer of economics, Mississippi State University, has been our guest. We're stepping aside for a break. We're in the Element Wealth studio, coming right back.